Well, I think what we're witnessing is just the diminishing impact of monetary policy at very low interest rates. And it's not something that, it's something we've witnessed around the world and we're just starting to, having to confront here in Australia. So the more that they lower interest rates and the less, at the end of the day, the central bank is targeting an end borrowing rate. They use the cash rate to target that, but if it's not flowing through, as interest rates get lower and lower, they have to start looking at other tools, which generally is balance sheet expansion, whether that's QE and buying government bonds or whether it's encouraging lending through the banking system through some form of credit easing. I think the first step would be QE for the RBA and buying government bonds. That's what they've communicated so far. And then some form of credit easing if that doesn't work. But I think they're tail risks for next year. Base case is that they don't get there, but it's a real discussion now. It's a live discussion. We're sitting here at interest rates below 1%, so it's not that far away. The challenge with QE is it's generally less effective than traditional monetary policy. As interest rates come down, as interest rates come down lower, you start doing other things like expanding your balance sheet, but it's not as effective. It has a positive effect, but it's not as effective. What could shorten the duration would be a big fiscal expansion if we got into a sort of a recessionary environment. At the end of the day, QE is facilitating fiscal. You're getting interest rates to a very low level. You're buying government bonds to make borrowing rates even lower. That works really well if the government then borrows at those low levels and invests in infrastructure or other things. So what could shorten the duration is a fiscal response to support that policy. If we don't get that fiscal response, then it can be a very long drawn out process at zero interest rates waiting for the economy to turn around. We have plenty of room for a healthy level of fiscal stimulus. So I think it would be taken very positively. So I think equity markets would perform well, credit assets would perform very well. I think you would get a steepening of the yield curve because the RBA would be holding the short-term interest rates low, and the government hopefully would start supplying the market with a lot of bonds further out, so that would steepen the yield curve. And you'd probably get the combination of that would probably start to lower the Aussie dollar. So I think those would be the most obvious outcomes, but broadly I think financial markets would take it positively just because there's plenty of room for the government to do that.